Did you know that some Nigerian stocks have delivered returns of over 1000% within a few years, turning small investments into life changing wealth? Yet, most people never benefit from these opportunities, not because they can't invest, but because they don't know how smart investors actually do it. Today, we are breaking down how smart investors make real money in the Nigerian stock market. It's not gambling, not guessing, but using proven strategies that build long term wealth. If financial freedom is your goal, understanding how this market works could completely change your future. And for this reason, we need to understand what the problems or challenges are. Now, here's the truth most beginners don't realize. Many people stay away from the stock market because of fear. They think stocks are gambling, you can lose everything overnight. Only rich people can invest. The market is manipulated. And honestly, some of these fears come from real life experiences. People who jumped in without knowledge, followed rumors, or invested based on hype instead of strategy. Another challenge is misinformation. Social media is full of self proclaimed experts promising quick profits, secret stocks, and overnight wealth. Many new investors also make costly mistakes. They focus only on price, not value. They see a cheap stock and assume it's a good investment, but price alone tells you nothing about whether a company is strong, profitable, or growing. So the real problem is not the Nigerian stock market. The problem is entering it without understanding how it truly works. Before we dive deep into this video, do me a quick favor to smash the like button and subscribe to my channel as part of your love and support. Also, feel free to ask questions in the comments. And if you want me to hold you by the hands and teach you how to invest in the Nigerian stock market until you become a pro, use the email on the channel description and this video below to send me a message. And without wasting much of your time, let's dive into this video proper. Now, the big question is, how do smart investors make money consistently? First, they research before they invest. They don't buy stock because someone recommended them. In fact, they study the company, its profits, debts, management, and growth potential. Second, they understand market trends. Smart investors watch economic indicators, government policies, inflation rates, and industry performance. They know that the stock market moves in cycles and timing matters. Third, they diversify their investments. Instead of putting all their money into one stock, they spread it across multiple sectors like banking, industrial goods, consumer goods, and energy, but not to the extent of spreading thin. This reduces risk and increases stability. And the fourth one is powerful. They invest with a long-term mindset. While beginners focus on quick profits, smart investors focus on time and compounding to multiply their wealth. Because in the stock market, time is powerful than timing. There's also a secret strategy that smart investors uses that an average investor is not aware of. The strategy is that smart investors don't try to predict the market, they position themselves to benefit from it. Instead of asking which stock will explode tomorrow, they ask which company will still be strong 5 or 10 years from now. This mindset changes everything because when you invest in fundamentally strong companies and hold them long term, dividends compound, stock value grows, and volatility becomes your friend, not your enemy. In fact, some of the most successful investors in history made their fortunes not from constant trading, but from holding quality stocks for years. The real advantage is not speed, it's strategy. Let's talk about why most people fail in the market. Now, let's be honest about something. Most beginners don't lose money because the market is bad. They lose money because they make predictable mistakes. Here are the common ones. Mistake one is following the crowd. When a stock is trending and everyone is talking about it, beginners rush to buy. But by then, smart investors who bought earlier are already planning to sell, and as a result, you'll be used as exit liquidity. Mistake two is panic selling. The moment a stock drops slightly, they panic and sell, but price drops are normal, and smart investors expect them. Mistake three is investing without a plan. Many people enter the market with no strategy, no timeline, and no goal. They just try their luck, and here's the simple truth: luck is not an investment strategy. So when you keep making all these mistakes, you're not being intentional with investing. Before smart investors pick stock to invest, they analyze three major pillars, which number one is financial strength. They check company reports to see if revenue is growing, profit consistent, and if debt is manageable. The reason is simple. A company that consistently makes profits has a higher chance of increasing its share value over time. The second pillar they analyze is industry position. Smart investors ask, is this industry growing? Will demand increase in the future? Is the company a leader or a follower? Because even a good company can struggle if it operates in a dying industry. The third pillar they analyze is competitive advantage. They look for companies with something special like strong brand loyalty, exclusive licenses, large distribution networks, unique products, and so on. This advantage protects the company from competitors and protects your investments. Let's talk about building a portfolio step by step. If you build a strong portfolio, you need to set up a structure to use for investing. This structure is no different from what smart investors use. Step 1, start with stable stocks. These are companies with long histories, steady dividends, and strong financials. Step 2, add growth stocks. These companies may be expanding quickly and can increase in value faster. Step 3, include defensive stocks. These are businesses people need regardless of economic conditions. Step 4, rebalance periodically. Smart investors review their portfolio and adjust allocations based on performance and market conditions. This structured approach reduces risk and increases long-term profitability. Now pay attention. If you remember nothing else from this video, remember this formula. Knowledge plus patience plus strategy equals long-term wealth in the stock market. Remove any one of those three, profit becomes difficult. Let's glance through how to spot undervalued stocks. This is one of the most powerful wealth building skills in investing, so we need to talk about it. An undervalued stock is a company whose true worth is higher than its current market price. This is where real opportunities exist. Smart investors look for signs like strong profits but low public attention, consistent dividends but weak media coverage. They don't chase hype stocks, they look for hidden gems. Because when the market eventually recognizes a company's true value, the price adjusts and investors who bought early benefits most. When trying to spot undervalued stocks, you would focus on their numbers and at the same time compare it with how they are being rated in the market. Talking about how smart investors make money in the Nigerian stock market, it is important that you think about market crash as well. And for that reason, let me tell you what smart investors do during market crashes. This is where real wealth is often created. When markets crash, beginners panic while smart investors prepare shopping lists. They've already researched the companies they want to own. So when prices drop, they buy quality stocks at discounts. They understand market crash doesn't destroy wealth. Panic reactions do. Historically, some of the biggest fortunes were built during downturns by investors who stayed calm while others sold in fear. If you are intentional about making money in the stock market, you need to understand how smart investors read financial statements without being accountants. Most people hear financial statements and immediately feel intimidated. But here is something powerful. You don't need to be an accountant to understand a company's financial health. Smart investors focus on just a few key numbers that reveal everything they need to know. The first is revenue trend. They check whether a company's revenue is growing consistently over years. Growth means demand is increasing, whereas declining revenue is a warning sign. 2. Profit after tax. Revenue alone is not enough. A company can make huge sales but still lose money. Smart investors always check if profit is consistent, if it's growing, and if it's stable during tough economic periods. Stable profit signals strong management and business strength. The third key number smart investors check is debt level. Debt isn't always bad, but too much debt is dangerous. Smart investors compare total debt and company earnings. If a company owes far more than it earns, that's a red flag. The fourth thing they focus on is earnings per share. Earnings per share tells investors how much profit a company makes per share. Higher or rising EPS often means strong performance, efficient operations, and growing shareholder value. However, there's something most people ignore that smart investors don't, and that is risk management. One reason why smart investors stay profitable long term is simple. They manage risk before they think of profits. This mindset protects their capital. They use methods like position sizing. I mean, not putting too much into one stock, diversification, setting exit rules, avoiding hype-driven trades. Because in investing, protecting your capital is the first rule of success. I hope this video helps someone make more money in the Nigerian stock market like other smart investors out there. I hope to see you next time. Invest wisely and stay consistent.